Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. We got so much positive feedback on his last interview about oil and natural gas stocks. We had to have him back on again soon, faster than normal. He is the founder of Capitalist Times. He also covers oil and natural gas stocks for over 20 years. Elliott Gue, thank you for joining me.
Oh, thanks for having me.
So, Elliott, we're recording this interview on Friday, March 31st, 2023. We've had a little bit of a rally lately in West Texas intermediate crude prices, almost to $76. Natural gas has been just absolutely crazy. It's a little bit above $2 at $2.21. I want to get your thoughts, though, on the oil and natural gas prices lately. Do you think that we had kind of a washout in the last month or so? Because on the commitment of traders, we were discussing this before we started recording, it looked like a lot of these global macro hedge fund people that are very short-term oriented, these short-term traders, they went super heavily net short all oil plays, also a lot of base metal plays based on, the recession, banking crisis. Do you think that we've had a washout in oil and natural gas prices?
I do. I mean, on the oil side, I find the commitment of traders data that you mentioned I find that very useful over the years. And basically what it is the Commodity Futures Trading Commission here in the US, and then the ICE exchange in Europe. Every week they report, the total position of different classes of trader, right? So you have, for example, you have hedgers, right, who operate in the financial futures market. These would be like the big oil companies, using the futures market directly or indirectly to hedge their production. Or it could be like an airline, for example, might want to hedge its exposure to oil or jet fuel prices. But what I like to look at is the speculator, which they call managed money. And these are, as you mentioned, mainly hedge funds, right? And they're using the futures market to speculate on the price of oil going up or going down. And I think that what you saw this year was a big bet on recession. And typically in a recession, you have declining demand for oil worldwide, and that pushes down the price. And we have seen a decline in oil in almost every recession going back for many decades. And so there have been a lot of bets on this, but I agree. I think the situation has gotten excessive. And what I like to look at is the net speculative position in both the West Texas Intermediate, which is the US oil benchmark, as well as the dated market, the Brent market in Europe, which is the key global benchmark. And if I look at the total net position of these speculators in both the United States and Europe, in both of these major global benchmarks, it's the lowest it's been since early 2016. And if you remember that environment, this was after a big decline in oil that started towards the end of 2014. Oil was well over $100 a barrel back in 2014, and it collapsed all the way through 2015 and into early 2016. And then, as now, a lot of investors were worried about a recession or a major global economic slowdown. On top of that, you had a major supply issue in the oil market back then. And so they had this huge, short position in this huge, in this very small net position in oil, and oil promptly, more than doubled over the ensuing year and a half or so. Because when speculators lean too far in one direction or another, it opens up the possibility for a move in the opposite direction. And we've seen this several times over the years. But it's interesting this year. The CFTC and ICE delayed release of this data. It's normally a weekly data series, comes out on Friday afternoon. They delayed the release of this data by several weeks due to a computer hack of this company called Ion in the UK that processes a lot of this data on derivatives. And so it's been a while since we've actually gotten a decent look at this data. But what I saw this past week, as they started, they played catch up on all these missed reports. We have the smallest net position in oil since early 2016, and so I do think there's been an overreaction there. And the supply and demand conditions in the oil market simply don't justify prices down here, under in the $65 or $70 a barrel as we saw at the recent lows.
And we're also getting close to the marginal cost of production for a lot of oil and natural gas producers. So not the low cost producers, but the average cost of production is getting awfully close for a lot of these producers. Now, you talked about 2016. I want to give a little more background, add a little bit more color for our listeners here, since both you and I have worked in the oil and natural gas industry and covered a lot of these stocks for years. So back then you had the shale bubble and the cost of capital was a lot cheaper. The Fed was subsidizing, keeping rates low for so long. So you had this shale oil boom and all this production, this shale oil production was just coming online. It was not coming on efficiently. We were talking before we started recording about how like these U.S. shale oil producers were just putting out press releases for Wall Street and investors presentation. And all they would talk about, they wouldn't talk about profit margins. They wouldn't talk about free cash flow. They wouldn't talk about paying dividends out. They were talking about just growth and growing oil production. And so basically you had a supply glut from US shale oil, and then the Saudis at the same time were starting to worry about their market share. And they also, I think the Saudis, the Saudi oil minister, didn't they have a lot of excess supply? So they were actively trying, I think from about 2014 to 2016 in that range, to bankrupt a lot of shale oil producers.
Yeah, absolutely. The Saudi oil minister at that time was a man by the name of Ali Al-Naimi. Actually, he has a book. It came out a couple years ago, which is an excellent read. But he'd been in Aramco, which is the national oil company of Saudi Arabia, since the 80s. So he had a long experience through multiple cycles with Saudi oil production. And I think what a lot of investors don't remember is Saudi did exactly the same thing they did in 2014 back in the mid 1980s. And what it was that coming out of, we had the 70s where oil and gas prices were very strong, particularly oil prices back then. And you had, as a result, you had all this investment in these new oil and gas plays. The North Sea of UK and Norway. You had Mexico's Cantarell oil field. You had the North Slope in Alaska. Tremendous non-OPEC production growth by the early 1980s. And so the price of oil started coming down in the early 1980s. And so what did the Saudis do? They started cutting production. They started kind of coercing or pushing their partners in OPEC, right, to cut production as well, to try to support the price of oil. And the more they cut production, the more they kind of propped up the price of oil, the more of this non-OPEC supply kept showing up. The more investment in new oil and gas reserves started showing up, and the more downward pressure on price it put due to that excess supply. In December 86, they cut production overnight. They increased production overnight to try to crack the market. And that's exactly what happened. And they allowed the price of oil to dramatically fall. And in so doing, they squeezed a lot of these higher cost producers out of the market. And, remember, Ali Al-Naimi, who was oil minister at the time, lived through this period personally. Most of the people that were around him, his sort of aides, lived through this experience personally. He referenced it in his book. He saw exactly the same thing happening in that era you're talking about, those initial years of the shale boom. I used to go to a lot, still do occasionally, go to these industry events, right? Talk to the energy executives, listen to their presentations. You said it was all about growth, right? It was, let's go out and drill a bunch of wells because these fields, this new technique of hydraulic fracturing has opened up all these new areas for oil production. Regions like the Permian Basin that were once considered very past mature, right? They've been in production for 100 years. This new shale intervals have totally revolutionized the business. So let's go out and drill a bunch of wells. We're not going to generate enough money, even at relatively high oil prices, to cover all the cost of this drilling. So on top of that, we're going to borrow money, and we're going to outspend our cash flow. And nobody cared, right? Nobody cared, because anything anybody cared about was volume, was growth in barrels.
Well, also the stocks were going up, like you said. So as long as those share prices were still going up, they were like tech companies, Silicon Valley tech companies. It was just weird seeing that out of oil and natural gas producers or any type of commodity company, because there's always CapEx involved with these mining companies or oil and natural gas.
Right, and that's exactly what it was. I mean, I used to when I started Energy and Income Advisor, my service, more than 10 years ago now. One of the things I used to do is I'd publish this chart where I'd look at each individual company and I'd compare their production growth on a trailing 1-year basis to their stock price performance. And it was almost a perfect correlation. That's what Wall Street cared about. So that's what these companies cared about. But you see, that assumed that view, that strategy, if you will, not really much of a strategy, but it assumed that, there would always be easy access to capital markets, which in turn assumed that commodity prices would remain, especially oil prices, would remain relatively elevated, or at least not drop below, $60, $70, $80 a barrel. And at that time, Saudi was, with the rest of OPEC, but Saudi in particular, was managing the price of oil to keep it around 100. And what started happening was, you have all this new growth in production from US, and Saudi Arabia was essentially accommodating that supply by cutting their own production. So, US oil production grows by 500,000 barrels in a period of time. Saudi and the rest of OPEC cut production by a similar amount to kind of keep the market balanced. At some point, Saudi realized, we're basically financing this whole thing. We're equivalently sending checks to these guys so they can keep drilling and oversupplying the market. And, that's what came to an end in 2014. And the resulting collapse kept oil prices down really from 2014 all the way up through most of 2020. And the result, though, has been that you have a very different industry today than you did back then. That gold rush phase is over. Now companies are firmly focused on generating free cash flow. It's all, you go to the same conferences that I attended, 10 years ago today, you'll hear companies telling you, what's their break-even price for oil, how much free cash flow can they generate at $60, $70, $80 a barrel, and how much will that mean for dividends for the shareholders. It's a totally different mindset. And if you look at a lot of these companies, I'm seeing a lot of going through the first quarter reports, I'm seeing a lot of these US shale producers talking about, 0 to 5% year over year growth in oil production this year. Compare that to the 25 and 30% year over year growth we saw during the boom years. It's very measured, and it's all based on how much free cash flow they can generate. They set their drilling budgets based on free cash flow targets, not based on trying to target some growth rate in the volume coming out of the ground.
So, Elliott, the lack of this growth rate that you just talked about, does that mean then that the Permian Basin over the next 1 to 5 years, because I've seen different estimates, but a lot of the experts out there, petroleum geologists, the CEO for Pioneer Natural Resources, he's just said some comments in the last month or so about the Permian Basin. It sounds like that, yes, CapEx is going to be put in, but not enough CapEx to continuously grow oil production enormously, and that we're going to have the Permian Basin, the oil production growth, start to either flatten out or peak and decline soon.
Yeah, I mean, the way it is that a conventional oil field and shale are kind of two different beasts, if you will, right? With a conventional oil field, you have a discovery. And typically what you do is you go out and you put a huge amount of capital up front to drill wells, but also to build out all the infrastructure in the play. And then production follows a very specific curve. So early on in the field's development, you see very rapid production growth, which happens because the underground pressure, the geologic pressure in the field is very high. And so your production of oil is very high because it's all driven by the field pressure. And then typically with a large field, it'll plateau, and it could plateau for many years, decades even, right? And then eventually you're going to hit the wall where the field starts to mature to the point that those geologic pressures diminish, and it's become harder and harder to sustain production. And probably you're going to have what we call a base decline situation where production starts to fall off. Shale, in contrast, is, I like to liken it more to a manufacturing business than a traditional energy business. The oil is widely distributed. You're not really finding anything. You don't need to really spend on exploration. It's a very wide area. It's not just one field or a group of fields in a particular area. It's a vastly distributed resource. And to produce more is all about drilling more. The more wells you drill, fracture, complete, and put into production, the more oil is going to come online. But you can only space your wells so close together, right? We're talking about many of these producers are, for oil, are drilling down, 5, 6, 7,000 feet, but they're also drilling horizontally 10, 15,000 feet. And so these horizontal wells kind of go out like an octopus in all different directions under the earth. And so if you locate wells too close together, then production from one well is going to interfere with neighboring wells and reduce your overall production rate. So companies can only space wells so far apart, right, without infecting their existing production base. So your ability to grow production over time is a question of your ability to drill more wells. And not only do you have to drill more wells to grow production, but you also have to offset decline in production from your existing wells, which can be 50, 60, 70% for shale in the first year. So you're kind of running on a treadmill. And so a company like Pioneer, CEO Scott Sheffield, what he looks at is he says, we have this acreage that we've amassed over the last 10 plus years in the Permian Basin. It's all excellent acreage. We have so many drilling locations in this space, right? If we drill, X number of wells per year, then it'll last. We can grow production at a shallow rate, say 2, 3, 4, 5% a year for 15 years or 20 years. If we drill, 20% more wells, we can produce more oil, but our inventory of wells declines. And what you're starting to see from these oil producers, and I think it's probably going to be most evident with some of the smaller names first. A lot of those are not even publicly traded, but eventually we're going to get to the point where these companies are running out of their primary drilling locations. And they're going to have to drill sort of more marginal acreage, which is not going to be as productive. At that point, you're definitely going to see a slowdown in actual Permian output, or output from any of the major shale fields in the US, not just the Permian. And that's the wall we're beginning to hit, I think, over the next few years. It's going to get harder and harder and harder to grow production because these companies are going to start running out of those primary drilling sites. And that's going to limit overall, U.S. production growth. I think U.S. can sustain some growth for the next few years. Probably sustain. We are the world's largest oil producer. Permian is a tremendous resource. I think we can sustain a lot of production for years in the future on the oil side, but it's going to become harder and harder, and eventually, it's going to start to decline.
Who are some of the lower cost producers right now? Are they shale producers or are they more conventional oil producers? It varies. Some of the shale plays, the Permian, I'll say it straight up, is the lowest cost U.S. shale production base. So you mentioned Pioneer, the symbol PXD. They are one of the lowest cost producers, if not the lowest cost producer in the U.S. They are primarily focused on the Midland Basin of the Permian. The Permian Basin can really be divided into two main pieces, right? You have the Delaware Basin, which is located to the west, and that is partly in New Mexico and partly in Texas, right? And then you have the Midland Basin, which is further to the east, and that's all in Texas. And the Midland Basin is going to be your lowest cost dollars per barrel oil coming out of the ground. The Delaware Basin is also a very low cost play. You're going to tend to see more natural gas production from the Delaware Basin. The Pioneer, right now, their break-even costs all in, and I'm talking free cash flow break-even, is well under $40 a barrel. And that's where they produce, is in that Midland Basin. You have other big oil companies like Exxon.
Exxon Mobil has a lot of acreage in the Permian. In fact, it's one of their growth areas. It's one of their growth focus points for the next 5 years. They have a 5-year plan out to 2027, and they updated it last year. They updated their corporate plan, and they're looking to grow Permian production a lot by 2027. So they're looking for Permian production to be. They were looking for Permian production to be up over 800,000 barrels a day, right? And that's going to be a sizable chunk of their overall production. Just last year, they grew Permian production, 90,000 barrels a day. And I actually think they might even be able to do a little bit more than 800,000 barrels a day by 2027, based on their more recent production results. This is competitive with the lowest cost plays Exxon Mobil has anywhere in the world, the Permian. Outside the Permian, though, the costs are a little higher in the U.S. And you look at a name like Exxon, right? The only other play in the world, I would say, that can compete with the Permian for them is Guyana. And Guyana is a play. I believe they announced their first discovery, which was called Liza, back in 2015. And last I checked, they had 25 or 26 total discoveries on that one block, which is located offshore of Guyana, which is in South America. And Guyana is they're expecting by 2027 to get that. They started the first couple of phases of the project last year. By 2027, they're looking at over 850,000 barrels a day of oil from Guyana, with a cost down around $30 to $35 a barrel all in. So it's a tremendously low cost play. So I would say, Permian is competitive with anything anywhere in the world, which is why you're seeing names like Exxon Mobil, Chevron, Occidental, all heavily invested there, as well as some of the U.S. shale players, Pioneer being one name that's very well known for investment in that area. Diamondback is another name that has exposure to both the Midland Basin of the Permian and the Delaware Basin. Similar costs, right? Somewhere between that $35 to $40 a barrel all in. And so that would be the lowest cost play in the United States. Outside the US, there are some plays that can compete with that. Exxon and Guyana, and then of course your OPEC, your Middle East producers have very low cost of production as well. And that's one of the reasons why I think they're going to kind of be back in a position of control for the global oil market for years to come. The reason being is that, as we've talked about, I think on the gas side as well, back when we talked about a month ago, the amount of capital spending by big oil companies, both names like Exxon and Chevron, but also the national oil companies, in new capital spending in new oil and gas development has collapsed since 2014. And as a result, there's very little non-OPEC production due to come on stream over the next few years. We're barely able to keep pace with the decline from existing fields. And OPEC is really one of the only places that's invested in growth. And as a result, they're controlling more of the world's supply than they did back when they started that sort of price war in 2014. And that gives them a lot of power.
Yeah, I was just wondering, since oil and natural gas have been in correction mode, downtrend for the last at least 4 to 8 months, what the profit margins are for a lot of these producers. So obviously with Saudi Aramco, their profit margins are probably going to be the best because the Saudis still have a good amount of oil and natural gas production from Ghawar, although that oil field has been producing for over 100 years. So the production that has declined, they've replaced that with higher cost deep water offshore production, but their costs are still probably $40, $50 a barrel. I mean, they're still significantly lower than a lot of other oil and natural gas producers globally.
Yeah, they are definitely, at most of your Middle Eastern producers, Saudi Aramco, for example, their core fields, some of those fields have break-even rates still today estimated at less than $15 a barrel, because they have to do very little capital investment to maintain production from a field like Ghawar in Saudi Arabia. But even at lower prices than we're seeing today, you're still going to see a lot of free cash flow, even out of a producer like Pioneer. For example, and I think this is a pretty good guide to what you can expect out of a lot of the Permian producers. Pioneer has a market cap of a little less than 50 billion. They're able to generate at $60 a barrel WTI. They're able to generate more than $3 billion in free cash flow, right? And with that, they would expect to pay somewhere around $11 in annual dividends, right? Total dividends, including their base dividend, as well as their variable dividend. So that gives you an idea, even at prices lower than what we've seen at the recent lows, right? WTI around 60. They're still generating $3 billion in free cash flow a year out of, a market cap around 48 billion. I mean, that's only from the Permian. At $80 WTI, they're generating more than twice that amount of free cash flow, and they think they can pay somewhere north of $20 in annual dividends. So, and I would expect.
Are you talking per share, $20 per share?
Yes, in annual dividends at $80 steady WTI prices. So that gives you an idea, and they're generating approximately $6 billion a year in free cash flow at that price. So, that gives you an idea of how cash generative these businesses can be, even at prices that are lower than what we have today, or a little bit higher in the case of $80. I would say, based on my read of the supply-demand situation for oil, we could see oil remain volatile because of concerns about recession near term. But the question to ask yourself is oil demand going to grow over the next 5 years globally? And I think it is. Has been growing.
Well, the other part of that too is also the supply side. So it looks like some of these, a lot of oil production globally in specific fields. So Mexico's not a net exporter of oil anymore with the Canarell field. Looks like they're going to be a net importer. So the normal places of oil exports and oil supply growth are just not happening. So the world, like the Permian Basin, has been carrying most of the global oil production growth along with Saudi Arabia for the last 10 years. And if the Permian starts to sputter out, I mean, there's going to be big supply problems on the supply side too.
Yeah, that's right. And, you have to ask, what. So in order to bring new supply online, I mean, the way commodity markets are all about supply and demand. So you have when the price goes up, it generally encourages more spending on new supply. It did in the 70s. It did, 10, 15 years ago in the last big cycle for oil. It hasn't to date, but in the sense that we've seen a big fall in global capex. But if oil prices are average, say, $80 or $90 a barrel over 2 or 3 years, I think you would see some new spending. And I think in particular, areas like deep water could grow. Obviously, the Middle East, you could see some more growth out of shale.
Canada too. There's actually a lot of mergers and acquisitions. Not sure if you cover a lot of the Canadian oil, the Canadian oil sands companies, but like Suncor and Canadian Natural Resources, they pay dividends, and they've been on both of those companies have been on big acquisition sprees.
Right, and that makes sense, but it doesn't make sense at $60 steady state oil. But I do think that what you're going to have to see is the price of oil rise to a level which incentives new investment and new growth in production from some of these companies. So I think $80, $90 a barrel is a good, longer term range for oil, a healthier longer term range for oil than 60 or 70. And at that price, I mean, a lot of these U.S. producers are going to be throwing off impressive free cash flow and dividends. Pioneer, $20 in annual dividends is about a 10% yield at the current price. And I think that's, they've done it in the past, and I think that's easily achievable for them longer term.
And the Canadian ones have over 5%. Suncor and Canadian Natural Resources over 5% yields. I think even like Chevron and Exxon Mobil have pretty sizable dividends too.
Yeah, Exxon has about a 3.5% yield. However, you got to remember that right now, actually, I mean, what they've been doing since 2019 is what's called high grading their portfolio. So they've been kind of selling off some of their slower growing older fields, which is traditionally what super majors do, and investing in these new projects like Guyana that have lower break-even costs and generate more cash flow. So they've kind of been using some of the proceeds from these asset sales to help fund growth. And so this year is kind of the turning point for Exxon, where their production is really going to start to take off next year and the year after and the year after that. And their cash flow is going to take off as well, based on even, I believe a lot of their projections are based on $60 Brent, right? And remember, Brent prices are typically a little higher than WTI. So you're probably talking mid 50s or so for WTI, which is even below the current range. And so they're going to be growing their dividend. In addition to that, they've already paid off most of their debt. I think the year-end debt was somewhere around 17 billion net. And that company has like a $450 billion market cap. So they've paid off almost all their debt.
I think they had in 2020, they added more debt. I think they had over 80 billion. So they paid off an enormous chunk of their debt.
The enormous chunk of their debt, and what they have, I mean, it's a very highly rated company, so they're not paying much on the debt they do have. They don't have very many near-term expirations either, last I looked. So they're going to also be buying back stock. So you're going to have the dividend, right, which I think they'll increase over time as they have been. It was the funniest thing to me is that back in early 2020, there was talk about Exxon, having to cut their dividend, and the idea that they were borrowing money to pay their dividends. But the reality is that these super majors are a unique business model. And I don't think that's fully appreciated. But the idea of these big international oil companies, Exxon, for example, is twofold. First of all, they have internal business diversification. Exxon gets about 65% of their profits from oil and gas production, which is called upstream. They also have a sizable chemicals division, petrochemicals, and they have a sizable refining division, refining and marketing. So they generate about a third, 30-40% of their profits from these other businesses, which also look very good, particularly refining right now. In fact, I think refining could be one of the best performing subsectors in energy this year. So they have this internal business diversification, which gives them some stability of cash flows, because when oil prices are low, oftentimes refining margins are actually quite attractive and vice versa. So it kind of gives you a little bit of offset, if you will.
Yeah, especially if you can export that diesel for a much higher price outside the United States. So you refine it here in the United States, you take those cheaper input costs for energy here in the United States, you bring that to the refiner, and then you make the diesel, and then you sell it outside of the United States for much higher prices.
Yeah, and I would say on the longer term dynamics, that's going to become more and more important, because in the U.S., we've lost about 1 million barrels a day of refining capacity. To put that in context, since 2018, 2019. And to put that in context, we consume about 20 million barrels of oil products a day, gasoline, diesel, et cetera, jet fuel. In Europe, refining capacity has been going down since 1980. Right. I think from something like 2003 till 2017, they lost around 3 million barrels a day of refining capacity. Since then, at least another million.
Well,
right?
They've gone hardcore ESG. I mean, look at Germany and a lot of these other European Union countries and the forced policies on BP. We were talking about this before we started recording on the European energy companies. They have even more draconian policies in place for ESG and green energy. So yeah, if they're going to block all these things, then there's going to be opportunities for American companies to export stuff there.
Exactly. And also remember that, obviously oil is a large input cost in a refinery, right? You use oil as the raw material to make gasoline and diesel. But what a lot of people don't talk about is that natural gas is also a absolutely crucial component of refining margins, because refineries are just in the business of heating up oil, mainly in the business of heating up oil, right, to separate the different components within a barrel of crude oil and cooling it down. And that producing heat requires some sort of fuel. Natural gas is the most common one. And even now, right, even though gas prices in both the US and Europe have come down, the US still has a massive cost advantage. At the prices we saw for natural gas earlier this year, I mean, refining isn't profitable, right? On almost any scenario, right? Because gas prices are too high, their input costs are too high. And on top of that, Russia was a major exporter of refined products to places like Europe. And obviously that's off the table now. So yeah, I think it's a great business for the US companies. They have cheap natural gas costs. They have more refining capacity, whereas a lot of other countries around the world have been shutting down refining capacity. We have the ability to export. A lot of refineries, for example, that Exxon or a company like Valero Energy owns are located on the US Gulf Coast, ideally positioned to export refined products. And we have cheap input costs from natural gas. So I think it's a little bit of a golden age there for refiners. And then, the other big advantage that these international oil companies have, these big producers have, is that they have the scale and the balance sheets to invest in these energy projects when prices are low. And, we're talking about Europe, and I think we talked about it before we jumped on the podcast here. But, BP in particular, Shell as well, in the last 5 years, when oil prices were low, what were they investing in? They were upping their investment in renewable energy and cutting their investment in fossil fuels. They were talking about not developing any new fossil fuel projects after 2025 or 2026 based on those same government, mandates and push, right, towards ESG. And as a result, now oil prices have skyrocketed, gas prices are skyrocketing. Those companies are pivoting back towards fossil fuels, but it's too late.
And they're playing catch up, to Exxon Mobil. And Exxon Mobil already has the acreage in Guyana and some of the other good plays. I know Hess Oil, Hess Oil is also an alternative there for the Guyana play. I know they bought a stake in it, but yeah, the other majors, I'm sure they'd love to go buy a stake in that, but it's not available probably.
Right. And, the beauty of investing in a downturn is that you pay less for everything else. So, hiring workers, cutting deals with the local government, very important, right? How much do they take? Are they going to take?
Yeah, royalties. Yeah,
their share, right? Their cut, if you will.
Well, yeah, they just set up a dummy national oil company, and they just get the royalty checks.
Yeah, they get the royalty checks, and obviously, if oil's at $40 or $50 a barrel, they're going to not be able to strike as good of a deal on that as if oil's at 60, 70, 80, or $100 a barrel. And there are very few companies with the scale like Exxon to go into a country like Guyana. I mean, Exxon's capital spending budget is $20 to $25 billion a year, and a good portion of that's going to Guyana. I mean, very few companies have the scale to pump that amount of investment into a country like that. And these are complicated wells. These are offshore wells, deep water wells, horizontal well developments. These are expensive and technically complex to handle. And a company like Exxon has the wherewithal, the technology, the know-how to do it. Most companies just don't.
But didn't you say before we started recording that at scale, though, once they have these wells completed, that their costs are actually pretty low, though?
Yes. The structure of conventional oil projects is that usually there's a huge upfront capital commitment, and then the ongoing costs are very low. So for the full cycle development, the fields in Guyana, Exxon's estimating somewhere around $30 to $35 a barrel is their cost there. I think they've sort of winnowed some efficiency improvements out of it. So it actually might be more on the low side there, but that is some of the lowest cost new oil that you'll see anywhere in the world, maybe ever, right? But certainly in the last 20, 30 years, and I think for the next 10, 15 years, because Exxon got in there when times were bad for the industry. They invested, counter-cyclically. And I admire them and their CEO because, they were coming under a lot of push to do just the opposite. If you remember, there was a hedge fund, engine number one or something like that, that was pushing them to adopt more ESG-friendly policies, to invest more in renewable energy, to cut investment outside the United States just in 2020, 2021. So not that long ago. And basically follow the European model. And in reality, they didn't do that, and and shareholders are going to benefit over the next several years because they have just a huge tide of free cash flow coming. They have said their goal is to double their free cash flow by 2027. Not their free cash flow, their operating cash flow, and they're on track to exceed that target. And a lot of people thought they were crazy when they first announced that goal back in 2019.
Yeah, they really cleaned up their balance sheet. I remember in 2020, 2021, because we didn't know the politicians and the bureaucrats had shut down the economy. So we didn't know when they were going to allow the economy to restart with the pandemic. But now that the economy has somewhat restarted and there was supply side problems in oil and we had the big oil price spike for a good amount of time. I mean, now looking at Exxon's financials and their balance sheet, they paid off a lot of that debt. So there's no longer the balance sheet concern. So they wiped a lot of that debt away. It was just, in hindsight, it was really smart. At the time, it was very worrisome because we didn't know if the economy was going to restart, when it was going to restart, because of the government, arbitrarily shutting down the entire economy and what oil demand and oil prices were. But in hindsight, it created like big supply side problems on the oil. And then you had Russia and Ukraine, and that caused a geopolitical risk premium on oil. Exxon benefited and paid off their debt. I want to actually ask you, though, as we wrap up the interview, about income opportunities for a lot of these oil and natural gas producers and pipeline companies. So I get asked these questions by people looking for income, but a lot of people right now are going into money market funds or looking at U.S. treasuries. I see a lot of hidden risk in some of these money market funds. It worries me about U.S. government finances, especially if you're buying U.S. treasuries at these prices and then the government starts cutting rates. Bond price it, or if the Fed raises interest rates. So if you buy an existing bond and the Fed raises interest rates, the bond price could fall. Do you think that these oil companies and oil pipeline companies, the producers, are probably relatively safer income bets than some of the more traditional income sources like a money market fund or a U.S. Treasury?
Well, I mean, you certainly have, especially with a treasury bill, you don't have a lot of interest rate risk because, a 1 or 3 month bill, you don't have a lot of interest rate because of the duration of the bond. But yeah, certainly on the longer term treasuries, you have interest rate risk if the Fed is forced to keep increasing interest rates to try to bring down inflation. I do think that there are some hidden risks in some of these money market funds as well. I mean, it is possible, and these are uninsured deposits, right? So it is possible that
they were also secretly bailed out during the 2019 repo crisis because these money market funds wanted extra income, and then they loaned a lot of their money market funds into the overnight repo markets. And then the borrowers of repo markets, which were these banks and hedge funds doing leveraged bond trades, they couldn't pay it back. So there was secret bailouts there back in 2019 that a lot of people aren't aware of. Yeah.
And there were some actually sort of in-your-face bailouts, if you remember back in the financial crisis years too, for a lot of these money market funds that broke the buck and all that. But yeah, I mean, I think that obviously you're going to have buying an energy company and getting these higher yields does entail a little bit more risk because you are going to have commodity price fluctuations. But I look at for example, Pioneer, I think, has one of the more straightforward formulas. It's a formulaic situation. What they do is they have a base dividend, which is $1.10, right? And what they do is every quarter, they take their total free cash flow, they take that $1.10 a share base dividend, and they net out that amount of cash multiplied by all their shares. And then they pay out roughly 75% of that incremental free cash flow as a variable dividend. They do the same thing every quarter. So that free cash flow already nets out their capital spending, their actual capital spending. And so you have this nice tie between their cash flow the price of oil and gas, right, and how much they pay out to you in dividends. As I said, at $60 WTI, $11 in annual dividends. At 80, it's more like 20 plus, right? So those are nice yields. So stock trades around $200 right now. So at $80 WTI, you can be looking at a 10% yield there. Now, I wouldn't say it's as safe as, say, a T-bill, in the sense that obviously, if the price of oil is lower than I expect, the dividend's going to also be lower. But I do think you can buy a company like Pioneer and say, okay, well, if you expect the price of oil to be somewhere in that $60 to $80 a barrel range, which I think is a very conservative estimate on the low end of that, you can expect a yield somewhere $11 to $20 a year in dividends. And as I said, it's a $200 stock, so you're getting a 5 to 10% plus yield there, right? And I think there's relatively low risk that the price of oil is going to sustainably fall below that low end of that range, that $60 range.
Yeah. So the producers, even if they're hedged, they do have, so you're getting income opportunities, but there's more risk there than, say, owning an oil pipeline company, because an oil pipeline company, you're not getting exposed to as much commodity risk unless the drilling entirely stops, which is very unlikely in most cases, where the drilling will just drastically be cut back. I mean, there's tons of contracts, and a lot of these producers are not going to drastically cut back on their drilling. Right.
That's very true. The pipelines are traditionally seen as more of a toll taker type of business. So a lot of them have minimum volume commitments. So, for example, a company will reserve a certain amount of capacity on their pipeline, and they will they have to pay for that, whether they use it or not. As a take or pay type contract. So that gives them.
Yeah, that's what I was referring to. So if you're for a case study for our listeners, so if you're a Pioneer Natural Resources and you want to move your shale gas or your oil, you want to move it to the refiner, or you want to get your natural gas to a liquefied natural gas export facility, you're going to have to pay the pipeline company to move it for you.
That's right. And for example, some of the MLPs, a lot of them are structures, master limited partnerships, that own pipelines. They also handle other services for a name like Pioneer, such as processing the gas and natural gas liquids that they produce as sort of an ancillary byproduct to their oil production. So you look at a name like Enterprise Products Partners, it's one of the bigger ones. The yield right now is around 7.5% or 8%. And that's pretty solid. This is a company that that has paid a reliable dividend for many years, and I think they'll continue to be able to grow it, probably in that 3 to 5% annualized pace range going forward. 7.5% yield is supported by those long-term, take or pay type commitments.
What are the risks for these pipeline companies? So the risks are, what if oil and natural gas prices fall, that the amount of volume of oil and natural gas going through the pipeline falls? Or is the risk to the balance sheet of this company if the chief financial officer and the accounting department is playing around with variable interest rate debt, and then the Fed raises interest rates, and then the company has too much debt on the balance sheet, and then they have to cut their dividend, and then they have to pay off debt? Then are those the two main risks?
Yeah, I would say with a lot of the MLPs on the operations side, there are two main risks. One is what we call volumetric risk, which is, as you said, that the volume of oil, natural gas liquids traveling through their pipelines diminishes, right? And so much from a particular area, say, that their fees, their tolls, if you will, for moving that oil or gas drop.
That happened in the Bakken, right? So that
has happened in some of those plays, yes. And the way I think you get around that is to go with a company like Enterprise, that has, first of all, wide geographic spacing of their businesses, right? So they have pipeline networks all over the country, but particularly in places like Texas, which, let's face it, is going to remain a center of the U.S. petroleum industry for forever, probably, for as long as it exists. So by having your widely dispersed pipelines in different parts of the country with different commodities, you do lower your risks that a decline or a loss of drilling activity in a particular field can crush your overall business. The other factor that you have to watch out for with these names, some of them anyway, is how much their earnings or cash flows rely upon gathering and processing contracts. Particularly, gathering is small diameter pipelines that collect oil or gas from individual wells and move that to gas processing facilities and then eventually to the longer pipeline network. Those gathering pipelines are very sensitive. Volume growth there is going to be very sensitive to how much drilling is going on in a particular region. So you want to avoid companies or MLPs that have a lot of gathering in a sort of substandard area or an area that's not going to see as much growth. Processing side, the processing business, the contracts involve taking a unit of natural gas and separating it into natural gas liquids, natural gas, and then potentially, which is called fractionation, dividing up those natural gas liquids into their constituent elements, propane, butane, natural gasoline, ethane as well. And some of them, it's a simple processing agreement. They get paid a fee based on the volume they process. Some have these contracts which give the MLP, and this isn't as common recently as it has been in years past, but you still see it occasionally. It gives the MLP some sort of benefit when the value of those natural gas liquids rises, but also gives it some downside risk if the net value of those natural gas liquids is lower, it falls. So I like a name like Exxon, which is much more of a fee-based type of operator than some of the smaller, potentially faster growing names. We had some, MLPs are generally seen as a really solid, low risk business, but it's important to remember we've had some of these names that have come under real trouble in recent years. NGL Energy Partners is a name that we haven't liked for many years now, but that's a stock that, it's been a terrible performer. It was trading up in 2019. It was, $10, $15 a share. And now I think it's trading under $2 or $3. And again, part of the reason for that, they had too much exposure to areas of declining volume and too much exposure to contracts that basically link them to commodity price risk. So it is important to be selective there, but yeah, that is definitely an area that you can get some higher yields in some of these names. You're not going to get the growth. You're not going to get quite as much exposure to rising commodity prices as buying a commodity producer like a PXD, but you do get, that more reliable sort of steady growth in income over time. And, I'd also point out that we talked about the refiners. Valero, for example, has about a 3% yield right now, is growing that payout over time. MPC, which is Marathon, which is another refiner. There are two Marathons out there. You got to be a little bit careful there. But there's a Marathon Oil Company, MRO, which is a producer. But there's also Marathon Petroleum, it's a refiner. That also has a fast-growing dividend right now. They yield around 2.5%, but they're growing their dividend at a pretty steady pace. They also have some midstream assets and pipelines. There's also yield to be had there in names like that.
And for listeners who are wondering, Elliott and I already discussed the cheaper natural gas producers, the lower cost natural gas producers in the US on our last interview about a month ago, and also liquefied natural gas export facility, that type of growth opportunities going forward. So the natural gas prices, they had a nice rally. They've kind of gone back down below the cost of production again. So I don't think a lot has changed there. I think more supply will come offline for natural gas, but liquefied natural gas export facilities will be coming online here in the United States. And there will be, especially if a company has a larger balance sheet like a Cheniere Energy, because Cheniere's just booking deals like crazy lately. I mean, they've just, the press releases that have have come out. They're just booking deal after deal, but they're already big. So if you're a small little company and you don't have access to the capital markets because interest rates are high, you probably can't go build a liquefied natural gas export facility. But there's the ability, if you're a larger company like Cheniere and you already have good balance sheet, free cash flow, you can go and expand your business opportunities in this environment with a cheaper natural gas and then exporting it for much higher prices via liquefied natural gas to other countries.
Yeah, I think one of the big things with natural gas is that, and I've had this question a lot from readers, but they're looking at the price of gas today. As you said, the front month price of gas was down around 2 the last couple of days. The April contract just expired, but it actually closed out under 2. The last time natural gas prices were under 2 was back in 2020. So I think a lot of investors who have some experience in this market are looking at the gas market thinking, oh no, we're back in the same situation as we were in 2020. But the situation is actually very different. If you look at the futures curve, right, back in 2020, the front month price was around 2. But the futures market curve going out to 2027 was pretty much flat at about $2 to $250 a million BTUs. If you go back to the end of March 2020, futures market saw low price of gas on the front month, but also low price of gas for years into the future. Today, the first few contracts, so now the May, June, July contracts are pretty low price. But if you look at the futures market next year, and certainly in 2025, by 2025, when a lot of that new LNG capacity is due, export capacity is due to come on stream, the price of gas is north of $4 a million BTUs, $4.50, $4.75 in the winter months in some of those years. So the market sees this, and right now we're dealing with this huge oversupply of gas caused by two things, right? The outage at that Freeport LNG terminal in Texas, as well as just a really warm winter. If it hadn't have been for those two things, gas prices would not be around 2 right now. But by next year, as those new LNG facilities start coming online, even assuming we just sort of have an average summer cooling season and average next winter, gas prices are going to recover a lot from where they're sitting right now.
Oh, yeah. I don't think hardly anyone can make money at these current prices in the U.S.
That's
and
right.
in Canada. And I think we're looking, and then drilling costs are up, oil service costs are trending higher. All these costs, input costs are all still, the cost of capital is still way higher. So we're looking at a much higher price floors going forward in the years to come.
Yeah, absolutely. I mean, they can, some of these companies have enough hedges that they can produce positive free cash flow over the next 2-3 quarters as we get through this low price environment, but you're not going to see any growth. I mean, if you look at the first quarter reports from names like Southwestern, Chesapeake, a lot of these companies are laying off rigs, meaning that they're basically releasing drilling rigs that they were using to drill new wells and allowing their production to fall through this year. And they're not chasing volume. They're lowering their production, allowing their existing fields to have their base decline, the production naturally declines. And they're not drilling aggressively into this. And I think you could see more of that. A lot of them are going to be reporting earnings towards the end of April, early May. And I think you might hear some more of these companies planning to decrease their production even more than they said on their Q1 call or their Q4 calls, last month. I think you could see a further decline in production from some of these names because of the low commodity price environment. And particularly watch the Haynesville Shale. The Haynesville Shale is one of the key shale plays for feeding these LNG export terminals on the Gulf Coast because it's located in Louisiana primarily. And it's a little bit higher cost play. So the break-even costs there are probably more like $3 to $3.25, depending on the producer, versus $2 for a lot of the Marcellus producers, $2.50 maybe. So watch those names. You probably will start to see a decline in production from Haynesville, I would think, by the middle of this year. And that is also going to help shore up a more bullish outlook for gas, because that means lower supply. I think you're going to have stronger demand by summer. even if it's just an average summer in terms of temperature. Europe is still a mess in terms of their energy markets. The only thing that saved them is a warm winter, right? But come back to me in July, right? And we may be looking at a lot of these countries like Spain, for example, Portugal. They have a lot of renewable energy capacity, and they have a very defined windy season, right? And other seasons of the year where the wind doesn't blow as much. And so they often see a real decline in renewable output over the summer months because that's their less windy season of the year. And when that happens, if it's hot this summer, which it could well be, natural gas demand in Europe should pick up, and you would see prices there also start rising again. They may not be in such a great storage position in terms of the amount of gas they have in storage come next November, December, when they start their winter heating season again, as they were last year. So I think there's a big mistake that people think that, the European energy crisis is solved because gas prices have come down. It's not solved. They dodged a bullet this last winter, but they may not be so lucky next summer or next winter.
Oh, yeah, I agree. And plus, a lot of these countries, Elliot, are announcing that they're going to start building that they're going to start building a liquefied natural gas import facility. Well, that doesn't solve their supply problem for oil and natural gas drilling. So they don't have their own domestic supply of oil and natural gas. That means they're just building a very expensive import facility. They still have to rely on someone else to do all the hard work, especially with much higher cost of capital, input costs going up, to find and produce the natural gas at a profit and then ship it via liquefied natural gas to that new import facility that's going to be under construction. So it's still a mess because they're building actually long term, if they're going to build new liquefied natural gas import facilities, it doesn't solve the supply problems at all. It just creates more demand long term.
It definitely creates more demand, and it gives them a little bit more diversification of supply. Whereas it continuously amazed me for all those years. Germany, for example, all their plans were basically relying upon Russian imports
and renewables. Yeah, those were the two things. Yeah.
Yeah, and the more. Whenever you go to Germany and you see all these windmills, you should be thinking about the amount of gas that has to be behind that. Because the thing is that the amount of output from a wind turbine depends exponentially on the wind velocity. So wind velocity going down 10% doesn't reduce your energy output by 10%. It reduces your energy output by 30 or 40%.
Wow.
And relatively minor variations in average wind speed.
So these things are really inefficient. I think that's the point here.
Yes, they are. And there's no way to store the power. So, what does Germany do? They host what's called shadow capacity. And so what that is it's basically a natural gas peaker plant, right? That can start up quickly and feed power into the grid when the wind power drops. So when you build a wind turbine or you build any kind of renewable energy facility that's got intermittent power, right, like wind, tide as well, all of these things, these nifty sounding new technologies, Germany found that they have to build 90% of the capacity of that plant. They have to build shadow capacity.
Yep. So, natural gas backup plants for baseload. Yep. That's what the average person, the environmentalists and the ESG people don't understand any of this. They don't understand the amount of plastics that need for electric vehicles, the amount of copper and silver and lithium that go into an electric vehicle. They don't understand any of this. Or how China has destroyed their entire environment for rare earth mining, for mining and processing it so they can have their windmills and their solar. I just got in an argument with someone in Europe who was telling me that they shouldn't have banned wind and solar and that it's good for the environment. I was like, so China destroys their environment then? So you can have all these electric vehicles on it. They just don't understand any of this. They ignore it or don't understand it. It's very, very naive.
Yeah, and it's pretty easy to manipulate the statistics so it sounds good. But I mean, even if you tell me that on a given day, 95% of Germany's power is from wind turbines, that's fine. But that doesn't mean that tomorrow it won't be 15% and the rest has to come from natural gas.
Exactly.
It depends on the weather.
Exactly. And if you're a consumer, right, if you're a business and you need the electricity to operate your business, so you're a bakery, a restaurant, any type of business, and even the internet electricity, right, or you're a manufacturer, a German manufacturer, and you have very unstable electricity costs, you can't compete anymore. And that's why these German manufacturers, because electricity prices are too high, the chemical input costs with the natural gas, that's why a lot of them left.
Sure. Yeah. And it's going to be a continued problem, and it has knock-on effects to everything. We talked about refining, for example. The costs of that are prohibitive.
Honestly, Elliott, nothing works in any of these modern economies, China, Japan, Germany, the United States, Europe, without cheap energy and cheap electricity. Everything was built off of that assumption.
Absolutely. And I do think you'll see some countries, for example, Japan, have pivoted back in favor of nuclear. And I think that could be a positive, because nuclear is a legitimate baseload power source. Our U.S. plants, and a lot of them were built, in the 70s, right, are operating on average at over 90% of their capacity through the year, meaning that whatever their rated capacity is, they're able to consistently output 90% of that capacity for months and months and months, steady. Right.
Mm-hmm.
Whereas, wind turbines, you're looking at 20 to 30% capacity factors in some cases.
Yeah, they can handle the wind turbines, solar and wind. They can be auxiliary, but they can't handle baseload. That's my narrative. I disagree. Anyone who says otherwise is manipulating the statistics. But Elliott, I've kept you for over an hour. I think you and me could go on about energy for a long period of time. You're truly a wealth of information on all these energy topics. If my listeners want to follow you on Twitter, take a look at your newsletters, how do they do so?
Well, you can follow me on Twitter at Elliott_Gue. And also you can, my energy newsletter is energyandincomeadvisor.com. I also have a Substack called The Free Market Speculator, where I publish a lot of free commentary, quite a lot about energy and also other market-related topics. So you can sign up and check that out. It's totally free to sign up, and I publish about twice a week there.
Excellent. Well, I always enjoy my conversations with you, and we'll have to have you back on again in a couple months.
I look forward to it. Nice to talk to you as well.